Good afternoon, everyone. It's 12:05 p.m. Chicago time on the 21st of January 2016. This is an open Ask Me Anything AMA webinar. Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not indicative of future results. We're going to be talking about some statistics probably as part of your questions. And please understand that statistics in their very nature are prone to variation with time. So just check the work before you use it for actual trading decisions. Got a lot of questions. Had to, oops, sorry about that. 1 second, need to clean this up. Had to siphon through these and clean them up to reduce the volume. I'm hoping to keep this to about an hour. So we should be done in about 1:15 or so, a little over an hour. All right, here's the sheet. I broke down the questions into categories: context, general, psychology. A lot of questions about S5, stage 5 trading, which I'll address at the end. I'm not here to, the purpose here is not to promote the brokerage or anything. But there are questions about that. Study, technical, and trade management. Let's start with general, just to kind of ease everybody in. Can you all hear me okay? Okay, first question by Steve. Steve's asking, is there a glossary somewhere that explains some of the terms used in the chat room? Yes, there is. Just go to the website, futurestrader71.com. Here it is. Nope. And just click on the top menu. There is a button for glossary. Here it is. Just hit the glossary, and it should give a large list of items, and I constantly update these. Just hit the plus sign and it'll give you an explanation of that particular term. Okay. Nikki's asking, what's your opinion on scalping and position trading? Do you think it's necessary to scalp first to learn order flow using bookmap before moving to holding longer term positions? If so, do you think it makes sense for a normal retail trader to scalp? How many trades that make sense for a day? My opinion is scalping versus trading is a decision that's based on several metrics, several parameters, key of which include the size of your account. Position trading cannot be done on a 6-tick stop, in my opinion. You would have to be absolutely perfect in your execution, and the market conditions have to be perfect, and there is no such thing. So if you're position trading, especially in futures, you need a sizable account, and you need to extend your stops and make each trade still only take or risk a small portion of your account, and you cannot do that with a $2,000, $3,000, $5,000 account. So if you're position trading, you first have to have a substantially more in terms of equity in a trading account. You have to extend your stops, and your entire outlook on the market has to change. Scalping Scalping describes a very wide variety of ways to trade. Scalping could be just simple order flow scalping, which is just playing the harmonics or the back and forth that occurs in the market day in, day out. Or you could be a scalper, someone who waits for legitimate setups, but then once you get in, you're only taking 5-6 ticks out of them. To be a scalper also requires a certain amount of preparation. To be a scalper requires you to have a good cost structure, because when you get into scalping, the cost of trading, meaning the exchange fees, regulatory fees, your commission to your clearing firm and broker start to eat the lion's share of your revenue and start representing a huge part of your overhead. And so if you're a scalper, one of the things you want to do is look at the exchange you're scalping on and see if there's a membership privileges that reduce your clearing. The CME is a classic, CBOT and so on. You know, moving from a non-member, which I think they charge $1.16 a side, so $2.32, something like that, to being a member, which is like 9.5 cents a side, plus some other fees, and then the fees drop off after a certain amount of volume. There's a huge difference in cost, and it doesn't make sense to be a member and to buy a membership or lease a membership if you're not doing enough volume. The break point for a product like the ES is around 78 round turns a day or something like that. So you need to get over 600 round turns a month for it to start making sense to do either an electronic membership, which reduces your cost by $1, or to start looking at a lease. Leases, I haven't looked at leases, but they're as cheap as $300 a month after the application fee and so on. If you're trading that much volume, it really makes sense in the order of tens of thousands of dollars a year to go to a membership structure. And to learn about that, just contact your broker, write to me. I'll hook you up with a broker here. They know what you need to do to start looking at a membership structure. So that's important for scalping. The other thing that's important for scalping is very good infrastructure, connectivity, your setup. You need to be in an environment where you're extremely focused. Scalping requires you to be fully invested in the market while you trade, whereas position trading, you know, you can watch TV or whatever until the market gets close to your area, then it demands your attention. But scalping requires you to be engaged. It takes a certain level of a certain way to think to become a scalper. So even though people talk interchangeably about these things, scalping really is a huge leap of a difference from position trading or swing trading. However, every trade starts with a scalp. Really, when you're about to connect with the market, you can certainly improve your entries and improve your positioning by having had some scalping experience. But I would certainly not start out as a scalper. The number of trades per day, I think for most people starting, in my opinion, is probably somewhere around 5 is good enough. You should be studying a time frame and a way to trade that gives you about 5 opportunities a day. Most people do not take more than that. Although the more trades live that you take, the better, in my experience, the better chance you have, assuming they're legitimate trades, the better chance you have of making the turn, because it's not about 10,000 hours. That is a myth, the 10,000 hour thing. It's about how focused it is that you're practicing, how deliberate your practice. It's a very important distinction. I think Malcolm Gladwell is taken out of context on that statement. It is not about the number of hours. It's about the number of trades you take that match your plan and teach you what you're doing wrong before you adjust, and then take more trades that are focused on just pure execution, focused on the process. The more you focus on the process, and this hits the psychology category as well, the more you focus on a process as opposed to focusing on the outcome, meaning money, the better the chances, I believe, for making the turn. I hope that answers your question. Michael, no frame of reference about futures at all. Does it cost the same to buy or short the ES if it's at 1,800 as opposed to 2,200? Yes, it does. You have to put up the same amount of margin. The current margin for the ES is $5,020 per contract. At the exchange level, that's the initial margin. After you put on the position, the margin you need to maintain to hold that position is around $4,800, I believe. Let me check my risk system here. It's been a while since I've looked at that. Let's find an open position in the ES, and it looks like $4,600 in maintenance margin. It costs you the same whether the ES is trading at $2 or $2,200. It's the same. The margin, of course, changes based on the volatility value of the product. So the margin reflects that change in price a little bit, but it's not like a stock. It's not like, I have to put 6 times as much more money buying a $600 stock versus a $100 stock. It's one of the major advantages to futures, the efficient use of capital. But with that efficient use of capital, you get leverage, and with leverage, you get higher risk. What does it cost to trade per contract? The ES per round turns about $5, and you're controlling approximately $95,000 of equity for $5 in and out, somewhere around that range. And your cost changes as you trade more, because the more you trade, the lower your cost structure generally. What are the gains losses per point move? Yeah, I suggest before you dig into, Michael, before you dig into futures, I suggest you go and look at the contract specs. I'm going to guide you as to where to go. Here's the CME site. You go to trading, equity index, okay? Find the product. These are the most popular products. Click on the S&P 500. Okay, this gives you quotes for the various expirations. We're in the March 2016 contract. You should go to contract specs and know what this says. And it'll tell you every tick is worth $12.50 minimum fluctuation. You'll be trading outright, so you're looking at outright trades. It tells you the times of day that it trades. The website has the calendar telling you the holidays. This will tell you the settlement procedures. All that stuff is very important as a trader to understand the product that you're trading, and the value of the index is $50 times the S&P 500 index. So every point is worth $50. Every point has 4 ticks, and each tick is worth $12.50. $50 divided by 4. So that's your source of details on the contract. Jay, you've been a professional stock trader in the past. Why did you change to futures? In your opinion, do you like better futures trading, ES, better than SPY, ETF? What are the advantages? Real quick, I covered some of that for Michael. The key advantages is it's lower cost, better use of capital. On a prop account of $50,000, I'm controlling at certain points. I'm controlling $41 million of DAX notional value. But again, that is leverage, and that's where the risk comes from. But if you're on the right side, leverage works for you. If you're on the wrong side, leverage works against you. With stocks, you can get margin, but the margin is being offered to you by your broker, and you're paying interest on it. In futures, you don't pay interest on margin. There's no additional cost other than your fees and commissions. Fees and commissions are a lot cheaper, dollar for dollar. The ETF versus the ES, the ETF is going to be a lot more expensive because you're paying stock commissions versus futures commissions and fees. There are many other advantages. In the US, there's the 60-40 tax treatment. Trading futures is considered 60% long-term, 40% short-term, so you get a tax reduction, tax advantage there, among other things. But those are the key elements. The biggest thing that got me into futures and never looking back at equities is that it is a level playing field, as level as it comes. Yes, you can argue that some people have faster machines and algos and all that stuff, but the fact is, the CEO of Exxon does not. The CFO of Exxon does not have an impact on the S&P 500 directly, whereas they have a tremendous impact on the stock. The market is open basically 23.5 hours a day, 23 hours a day or so you can interact with the market at all times. And it tends to follow a pattern once you get used to it, and it takes a while. once you get used to it, you start to see a character to every futures product, whether it's crude oil, ES, the bonds, notes, gold. They have a certain personality. Whereas with stocks, we used to have these. I used to have about a dozen stock boxes on my screen that I would hit the space bar to flip through, and each one of them is very different. For me to create the same types of opportunities that I see in futures and stocks, I have to spread my trades across multiple stocks. I don't like doing that. I prefer to focus on a product once I learn how it is. One of the other advantages is there's no day trading rule. You can buy and sell futures as much as you want, as much as your account can stand it. They're mark to market every night. Every night you're debited or credited your amount. There's no paper money. There's no paper profits. All of those things. That's just some of the advantages of futures. Darren's asking, I understand your rationale behind handicapping the overnight session profile and why you don't use 24-hour profiles. When it comes to an equity index, the underlying basket, not trading, but would you use the same principles for contracts like the notes, crude oil, etc.? Okay, so Darren, that's a good question. The reason I refer to the overnight profile, and that is this. So I look at the overnight profile to see what the market has done overnight. These are the profiles with the blue boundary, the blue boundary on white. Those are overnight sessions, and as soon as the market opens, I create a brand new profile and new lines and everything else. And the reason I do that is because we are trading a futures contract, and a futures contract has an underlying product. A futures contract does not stand on its own except for physical commodities. Physical commodities, the cash equivalent is a barrel of oil, is so many heads of cattle, so many bushels of wheat, and so on and so forth. Other than that, there's no cash market. So it makes sense that if the stocks that make up the 500 stocks in the S&P 500 aren't trading, then is the index future representing those stocks, or is it simply piggybacking movement in other indices, which is mostly the case? But that's not true for crude oil. Crude oil is traded at desks across the planet. The crude oil book is transferred from one trade desk to the next like an FX product. The main markets in crude are obviously New York and London. So I look at a 24-hour crude session. So if you look at the crude chart here, it's a 24-hour session, but I put significant so here's a 24-hour session. So this is from yesterday's close all the way through yesterday evening, through midnight here Chicago time, through the morning. But then when the pit opens in the US, I create a new session. So you can see how the initial balance changes, and now I create new statistics and I go by those statistics. So I'm essentially trading the New York or the pit open here in the US as my main session. But crude oil and currency products, they get a little bit more complicated because they get carried around the planet because they're key commodities, they're fundamental commodities. Notes, I go with the pit. At 7:20 a.m., that's when the notes open. Yes, they move around overnight. Yes, there's some movement and they're thinner. But they're not, I still refer back to those. I'm not ignoring the overnight session or the Globex session or the non-cash session. I'm not ignoring it. I do refer to it as part of my preparation, but I do not include it in my statistics and my studies and so forth because it's not built on anything that has an underlying. So if you look at the volume that trades at the end of the ES session and what happens at exactly 3 o'clock Central, 4 o'clock Eastern, when Wall Street closes, if you look at that on Bookmap or some other product that tracks order flow and volume, you'll see that it significantly falls off. And the reason for that is the index stays in line and makes sense once the cash product is still trading. It is also a personal choice. I'd like to simplify things to what I need and only what I need. And I'm very, very skeptical, and I'm very cautious to add things to my repertoire or to the things that I'm looking at. Jason, can you explain if there's a market maker in the ES, where do all the orders go? There is no market. There are market makers in that there are designated firms there are firms that are designated as market makers in the S&P in every contract, but they don't do the same thing as a specialist on a New York Stock Exchange. They're not taking the other side of your trade. The market makers are simply there to make sure that the market has a reasonable bid and offer at all times. And you see them all the time in an order flow tool like, again, Bookmap, which is what I use. But if I turn the contrast here a little higher and I zoom in a little bit, you'll see that there's this dark gap around the best bid and offer all the time. And then just outside it, there's a lot of noise here because of the volatility. But there's, the market is thinnest near the bid offer, but as you go outside all day long, there are these orders that track the market. You can see them right there. Let me see if I can get my pen here. You can see these orders tracking just outside. Those are just market making algos, and they exist in thinner products. They're much easier to see. Let me pull up my NQ. So here's the NQ instead. Let me turn up the contrast. And let's see this dark void. These two lines are the bid and ask. See how there's a dark void just outside of the bid and ask, and then it gets thicker as you go farther away from the bid and ask. And that's part of that. A big part of that is market making. These are generally algorithmic, but there is nobody keeping a book, for example, and balancing a book like on a New York Stock Exchange. You are trading on the matching engine at the CME, as is everybody else on the planet. And the matching engine connects the buyers and sellers directly. There's no person in between. The purpose of market makers is simply to respond to requests for quotes, RFQs, and things like that. And in today's market, in active products, it's not necessary to do RFQs. And options, certain option products, certain liquid products, you might get that. And the market maker's obligated within a certain amount of time to give you a quote for the product that they're market making. As I watch a 512 tick chart and I see 500 on the bid and 400 on the ask, that will say 1875 quarter, and on my tick counter, tick countdown counter, it will say 350, and then I see price move up to 1875.75, 2 ticks higher. Yet the tick countdown, which now reads 315, where did all the orders go? So it's not necessarily spoofing that you're seeing, but people have the right to cancel their orders if they do not see the market responding in the way they want. A lot of that is just people flashing orders that are not real, but there's a crackdown on that sort of behavior where you have to trade a certain amount of the bids and offers that you're putting into the market have to actually trade out. But I do that all the time. I might be working something, the market comes in, and I don't see an advantage, and so I cancel my orders. And if I'm doing it and 300 other people are doing it, then you'll see that effect in the book easily. But that's just part of being in a market. It happened in the pit. People put their hands up, and as the market responds, they may take their hand down and not want to place their bid out there anymore. It does happen a lot more electronically because there are machines that are very, very fast that do that, but that should not figure into your trading. It's irrelevant to your trading, because if you're sitting there and your trading plan is just to lean on a bid or an offer, you're going to be disappointed. Joe, can the concept of market profile be used for short-term swing trading and not just for day trading? Yes, it can. The same information can be broken down and used longer term. So this is my daily profile chart. This looks awful messy. We can turn this off here. Let's turn these lines off. There we go. But essentially, if you're looking long term, you are combining a lot of this information and you're looking at the overall shape and overall participation of the profile itself. For the intermediate swing trader, you're looking at micro composites. For example, yesterday, as I discussed in this morning's Trader Bite, yesterday, for today, the expectation is for it to test higher, fail, push down to 35.50, and then bounce around in there, and then start to resume its move towards yesterday's high again. It did not quite do that. It did not push far enough, or did not push as far as I expected. But the market has done its job. It has gone back to the 1872, which is the most valuable price or the most traded price over the last 3 days. At 1872, it has pushed through it all the way up to 83 1/4, and now it's falling below it, and it has to, the buyers have to be getting nervous at this point. The bidders have to maintain the market above 1848.75 for this to continue higher. So that's a swing trading kind of idea. So it's the same information. Market and volume profiling are not a trading system. It's just a way of organizing information. The easier thing to do, actually, is to go to market profile. And what you can do with market profile is just combine these profiles. This is a weekly, which I don't think you can combine. Merge right. Yes, you can. Good. So you can combine these weekly profiles to look at the last 3 weeks and see where the market participated a lot, what prices it rejected, and so on. And so this represents everything going back to the 4th of January, the first trading day of the year, a couple Mondays ago. And now we see that we're trading down here. So the market has to push through this low volume node and make its way up to push back into the 1915, which I also talked about today. Once it gets to 1915, it's likely to push through to 1970. And once it gets through the 1970, then it's likely to push through to 1988, to new highs, and then move back into where we were at the end of the year last year. So you can formulate all kinds of ideas based on this. And later on, we're going to address a question regarding how to use that for options, which I do. I look at profiles for options. So that takes care of our general part. Let's look at psychology questions. Malcolm, I have a full-time position in research at a fund and use futures to invest, trade on swing or long-term basis. I was shorting highs the last 6 months based on research that is currently playing out. Anyway, I held and market kept bouncing back to highs, but stayed in because research and plans suggested exit at 10, 15, and 20% down. 20% is a lot. I was able to take 20% off in August, 20% of your position in August near flash crash lows, fortunately. This time I exited at break even, thinking I'd just reload on another retest of highs and get better price. That never happened after seeing my plan work out, but not profiting. I'm afraid to take short-term longs or shorts because how fudged would I feel if the thesis was short and I lose going long? Also afraid to short now because I was in at some a much better price before and risk much bigger here. So there's the fear for losing money on a short side when I was all right, when I was right all along. How do I move on from this? I felt I deserved to profit from this. So you're having the same response. You're having the same response as someone who came into the day with a day trade that says get short at the open, and then they didn't get short. They watched the market fall, and then the market goes sideways, and they're just completely stuck with the fact that they had called the market right. They should have been short at the open. They didn't short. How stupid that was, and therefore they cannot see the next trade. And if anything, they'll start getting long because the short isn't something that worked out for them. So it's the same type of psychology, okay? And you're not going to like what I'm going to tell you because it's true. Who cares? That's the bottom line. That was a trade that you set up with research that played out. 6 months took for it to play out. And that trade is done. It is, water under the bridge, spilled milk, or whatever you want to call it. It is done. There is no point to expending energy on the idea that has already played out. The upside to you is that your research played out. Why can't your research be applied to now? Because everything is happening in the market on the hard right edge. There's nothing I can do about this massive 15 minute bar here. When my expectation was for 35.50 and for it to break this overnight low, and it looked incredibly good this morning to go for that overnight low. There was a loss here. I took the short, the mid short, and it just blew right through. I can't sit here and wonder how could I have missed any clue, or how could I not be long? How could I have missed everything from there to there? It just doesn't matter. The same things that prepared me for the short, that prepared you for the short, should be able to be applicable to finding the next trade, because all you have is what's happening right now. This last uptick, this last downtick, that's all you have. That's all you can act on. And so I wouldn't worry too much about how terrible you're going to feel because you're now getting long against the short idea. But the market, once it sells off like it has, the market bounces generally to either have a pullback for a continuation move down, or it bounces to be corrective. In other words, it bounces high enough, has a brief pullback, and then continues in the other direction. It's the nature of the market. So you have to be okay with long and short, first of all. Otherwise, you're cutting your possibilities in half. And so I would turn to whatever research you were on that told you that things are really messed up and you should get short. I would turn to that research and figure out how it can be applied today. If it's not applicable today and it has to wait for the next new high, new all-time high, for you to consider short again, then so be it. Then you're a one-trick pony, and that's your trade. And it's great that you've identified the trade, but that's your trade. What I would do in your situation is to go and find other ways to look at the market, shorten my duration or shorten my time horizon, and look for more opportunities. It's kind of like I get asked this a lot by people who say, I have this one setup a day, and sometimes I get on it and I get stopped out to the tick, and then the market goes in my direction, and I'm frustrated for the rest of the week, and because I'm done for the day and I have to kind of live with it for the rest of the day and stuff. And it just seems like you're just self-torturing, giving yourself a binary opportunity of getting short and catching a 20% move. Otherwise, there's nothing. Is a very difficult way to approach the market. Now, you have a full-time job, and it's fine for you to look at the market every few weeks or months or whatever. If that works for you, it's fine. But it's the idea is that this is a statistical project. The market is a statistical, probabilistic living thing. And in statistics, the population sample is an important factor because we cannot base true or false on one coin toss. We're not going to get 50-50 on a fair coin with one coin toss. It's either going to be heads or tails. But over thousands of coin tosses, the outcome of heads or tails are likely to converge towards 50%. They're not going to be exactly 50%. They may cross, but you need a lot of samples. And so hanging on to the idea that you guessed the market right yet you didn't get it right is not the way to go. I think you probably need to, it's great that this plan worked out for you and you took your time, but there's really not much you can do about it other than to look at the market and figure out if your plan or your research can be brought to a shorter time frame, because that's what you're struggling with. There's a divergence between what you want to do, which is to be right on your research and to be on that trade, versus the fact that you have nothing to do now and you missed the big trade, missing the big short in 2008. You can't sit there and dream about how could you ever buy a house again? How could you ever buy real estate again, given that your research showed how over-leveraged real estate is and that it would cause a crash? Well, guess what? In 2009, 2010, you had bargain basement land values and home values. You could scoop up all kinds of properties real cheap that are now up 20, 25, 30%, depending on your area. You can't just focus on the fact that homes are over leveraged. That has come and gone, okay? So I know that sounds harsh, but it's the truth. Alexander, I was one of those guys trying to catch the reversal in yesterday's ES. After putting in my best week ever in futures trading, I gave it all back yesterday. It is painful and dumb. Can you provide some tips on coping with a loss and maybe tell us a time you experienced a pitfall in your trading journey? So this is a common issue for traders. Couple things you need to look at here, Alexander, is what is it that makes you believe that buying yesterday or that the reversal is coming and therefore you, I don't know what size account you're trading or how much volume you're trading, but why is it that you are the one that should be catching that reversal? Why do you put yourself in a position where you have to guess where that reversal is as opposed to seeing it? And the reason I say this is when I look at yesterday's action, and I warned about this on Twitter, as it's falling, there are a ton of people buying this. Buy. And they're looking for that huge reversal up because it can't keep going down and so on. And the market rewarded some people with that big reversal and the push up. It rewarded some. But trust me, it is a short-lived reward, because if you are someone who was in the hole 2, 3 grand, 4, 5, 10 grand yesterday, and you held on and you end up making money, the market did not do you any favors. I guarantee it. There's very few things that I can say I guarantee it about in trading, especially since I'm licensed. But I can guarantee you that holding on to that massive loss, which multiplied your loss limit, and you hung on and it gave you a 65-point rally to take you from being really negative to being flat or being really negative to being up a little, you have just created an environment, which I've seen over and over again, to hold on again when it doesn't come back. There's no way for you now to know that you will get out and you will follow your plan when you're deep in the hole, because the last time you were rewarded for doing that. So if you were down 4 grand last time, getting long and holding on and wiping away a couple of weeks worth of effort and profit, and you got rewarded for that, and you went from being up $1,000 over the last couple of weeks to being down $4,000. What's to stop you from being down $5,000 because it needs more room? How about 6? How about 10? That's not a trading plan. There's no way to sustain that as a career, as a business. So your question, which relates to how do you cope with this loss? I would look at why it is that you are looking for the reversal. What I do, and all I can do is trade what's next. What I do is I go with my context read and my hypothesis, which I'm sharing with you on the Trader Bites every day. And then I look for an opportunity to play that context. And a lot of times the market doesn't agree with it and will push through. Today, had a pretty clean setup, really, to get short the pullback. The market had all the pieces together for me to look for, okay, so we've got the drop, so here's the move. Now it's pulling back, so here's the area to get short, okay? Gave you one scale out, and then boom, it exploded, tested the other side of the of this confluence area, which was a low volume node plus the opening swing low right here at 50 and a quarter, plus the mid, plus VWAP, all together here. But it came all the way back and it tested the other side and started running. To me, that's what I need to see. In the sense, there's another question down the line. That's what I need to see. This should not have happened, and I'm using the word should lightly. This should not have happened if my bias or my hypothesis of a continuation, a pullback and a continuation to 35.50 right here were still true. This should not be happening. The fact that it's going back into the opening swing gives me a close to 80% probability of it testing the other side. So it's time for me to get out, and it's time for me to look for longs to play hypo 2, which is to retest 72. We've gone to 74 so far at that point in the session. We've pushed through that now, but the point is, coping with the loss makes it sound like kind of a dire long-term thing. But the fact is, if you're giving away that many days, best week ever, and then giving it all back in one day, something's wrong with your risk-reward ratio. If one loss, one day of losing, wipes away an entire week, then something's not right, because you're giving too much room to your losses, and that's not a sustainable trading plan. And so that's where I would go to cope with this. I would look for, what can I take away that prevents this from happening next time? And why am I trading these reversals? What am I leaning against? And the context yesterday was all short, was all south. I don't know if you were part of stage 5 or not, but in the chat room, I always ask in the morning, what are the boulders today? What are the boulders that make up the foundation of what we have so far? And I'm looking for answers, and I get the answers that agree with my assessment, which isn't always right. That, hey, the market could not push into and hold yesterday's range upwards. It opened in a gap down. It actually crossed the open downwards and is moving into new low territory over the last few months. So there's nothing here that says too cheap, buy it, too cheap, buy it. There's nothing there. It's shorts. So until that mindset of, I've got to catch the bottom and catch a 65-point ride, until that mindset goes away, you will likely experience that level of disappointment and loss over and over again. Yesterday, it pushed a little bit higher, then it started to fall. Target 1810, no reason to get long, whatsoever. And so it pushed through the 1810, bounced around in there, and then a buyer came in and took it all the way up. I could not have predicted that. But I certainly, even if I were wrong, it certainly would not take away my best week, and that's where you need to focus. Your need to be right has to be addressed. And you're doing it in a way that is very common. All of us are contrarians. We want to buy the absolute bargain basement low, and we want to sell the highest high we can find. But in trading, it's very difficult to do that, for one, especially with a small account. You need really wide stops. But also it's a double-edged sword in that uh, you're going to experience the maximum number of adverse trades or adverse experiences doing that. So I would look for a different way to trade, and I would definitely address how much you're risking on every single trade, because you're obviously risking too much. Don, let go of outcomes. Easier said than done. That's correct. It's what we're here for. Not to get religious or spiritual on you, but in, you know, with kids, with spouses, with business, with life, with the passing away of our parents, it's all unpredictable. It's all unpredictable, and our mind would like to wrap itself around it and make it predictable. It's all unpredictable, and eventually, one way or another, and this is what trading is amazing at. This is what trading has done for me. Even if you fail as a trader, looks like the NQ is really dropping. Even if you fail as a trader, the one thing you can walk away from, that you'd want to walk away from, is the ability to take things for what they are, to basically see every moment as unique as the very next trade, because every single trade is unique. And so it's the letting go of outcomes is definitely not a pill. It's not a blue pill from the Matrix or the red pill from the Matrix that you swallow and there's your reality. It changes. But over time, you'll start to realize that the heartache and the pain and the carrying on about how that trade happened, and those guys and the market's jacked up and the market is rigged, and all of that becomes just you talking to yourself, and there's no product from that conversation whatsoever. And so let go of it. Let go of the outcome. You have to look to the next trade. Do you believe that the last trade has zero bearing on the outcome of the very next trade? Do you believe that? If you do not, then you need to look into that. You need to look at the evidence and convince yourself that that is true. Every trade is discrete. Every trade has a discrete outcome, and it is discrete of the prior trades. Okay, the example I've used in a recent AMA with S5 is you have a room full of men and women, 50% men, 50% women. A man comes out, you're standing outside the door, and you're supposed to guess, and you get paid or debited based on whether you guess right or wrong, if it's a man or a woman coming out of the door. A man comes out of the door, the population has 50-50 men and women in it. So that is your overall edge, the overall possibility of your trade. Okay, a man comes out, you guessed woman, so you got that wrong. And because a man came out, are we right to expect a woman to come out because the population has 50% women in it? Should we be able to say, well, if the last one was a man, then the next one has to be a woman because the outcome has to change? What do you think? It doesn't. It could be man, 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 woman. And there's a twist with the market. It is not a room full of 1,000 men and 1,000 women, and once you get through with 1,000 men, now you can be 100% sure, the reverse martingale thing, you can be 100% sure that every single one is a woman. No, because the man that came out of the door at the beginning, he walks around the corner and he walks right back into the room, and he mingles, and you don't know where he is in the room anymore. That's the market. It is not a definite, and it is not a closed data set. And so you have to learn to let go of outcomes because it's constantly going to surprise you. So don't be surprised. Know that anything can happen in trading. Okay? Anything can happen. The outcome of the very next trade is unknowable to everybody. including the smart guys at Goldman Sachs or whatever. It's unknowable. Okay, one. No, given that it's unknowable, the only control you have is when you get in and when you get out and how much you're willing to risk. So risk control is king. I'm not saying that because it's a textbook thing. I got to say, it is the truth. Okay, so once you kind of absorb that and it becomes a part of who you are, you will start to recognize that actually you can let go of outcomes because they're pretty random. They're pretty much random. Over a large data set, you will start to converge towards your edge, kind of like that coin toss that eventually converges towards 50-50, 50% heads, 50% tails. But on the very next coin toss, could be heads, 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 tails, heads, heads, heads. You just don't know. And so the fact that you flipped a head and you're looking for a tail, you can't sit there and go, God, why didn't I get tails, man? That's two heads in a row. It's an unfair coin. This sucks. And that's not letting go. That is attachment to outcomes. The fact that you're in this knowing that the very next flip could go either way helps you relax. It reduces the fear of missing out, which is a very powerful emotion that we experience because the market's constantly creating opportunities for both winning and losing. And if you don't believe that, then you will have that fear of that issue with outcomes and saying that I'm just full of crap or whatever. But eventually, if you're here long enough, you will come to terms with that fact. And it stops you from fighting and fighting and fighting. There's a point in the day where I recognize that I'm completely wrong and I should not be trying and trying again. Brian, for you personally, what was the aha moment in your trading where you went from someone that was marginally profitable or break even to very profitable? Was it one event or a process? It's definitely a process. My aha moment for equities was the fact that there were people in the room making 100 grand on some days, and I was losing $1,000 on those same days. I knew that something had to do with me rather than the market because we are all looking at JDSU, Dell, Microsoft, and so on. We were all scalping the same product. So that was a realization. So I spent a lot of time on psychology and attitude and a sports psychology and so on. But I got lucky in trading equities. I got lucky when I started to make money there. And then I had to switch to futures after 9/11. And when I switched to futures, that's where I got the real education. That's where I basically did everything wrong under the sun and tried everything. I tried everything, moving averages, this, that. I didn't stick with anything for long enough to see if it truly works. But the aha moment came when I recognized that I was running out of money and it was the end. I basically went from having pretty substantial savings to pretty much nothing with a newborn child that was 3 months old, and I needed to do something. And what I did is to just kind of, I don't know how to say this without basically basically accepting that the end is near and telling myself that since I accept that the end is near and this isn't going to work out and I'm going to go borrow money and find a job and so on, then why don't I just do 150% of what I'm supposed to do? I know what I'm supposed to do. It's just that I wasn't doing it. I could fudge my way around it. I know I'm not supposed to, add to a losing trade if that wasn't in my plan. But it looked good, so I'll add just this once. It just got to the point where I needed to get serious about the fact that this is probably going to come to an end. And so that's what woke me up. And then I just started to just relax. It helped me relax, knowing that, I might have to, now that I've moved to Chicago and now that I've been here and done everything wrong, I come to terms with the fact that I probably am going to lose this job as a prop trader, and I'm going to have to go find something else to do. Once that became a realization, and once I accepted that that's what it was going to be, it became a lot easier for me to just wait and be patient, and just let things set up. And so I would skip the first half hour trading. I would look for which side had more power, had a bigger push, and I would look for areas that made sense for me to trade against. And then I would take trades, as opposed to like the last question where you're looking for the reversal, and that's what I was doing all the time. I'm looking for the reversal. I just kept looking for the reversal against the trend and then trading with the trend. That's one of the things I did. One of the biggest days I had, the first time I breached maybe $1,000 on a day, was in the Euro stocks. And that's basically what I did. I just sat there all day and I looked for, from here to here, is it bigger on the upside or is it bigger on the downside? And that's why you see these numbers on my charts, right? So a lot of people who followed me, who have my chart definitions and so on, get these numbers. These are rotations, and that's what changed my career. And I always tell people, pay attention to the rotations. The rotations are very important. They indicate who is in control at that moment. And then once things started flowing, there was a lot less noise. And I attribute the fact that I was a meditator as part of the process to be able to just calm things down enough to just see the market for what it is. So it wasn't one thing, it was just a series of things. But the most important part of it is you've got to develop a healthy respect for the fact that this market can do whatever it does. It is not there to get me. It does its job. I just need to do mine. And the only thing I can control is what I do and how much I risk in doing it, period. Once you come to terms with those things, you kind of do away with a lot of the noise and you start to see things for what they are, at least I did. Jason, big question. I learned so much over the last few months since joining S5 and want to thank you for, I feel I've made great progress. Very happy to hear that. Takes a lot of work to hear those words. However, this was probably addressed before, but I have been having this issue recently where after several winning trades, I end up losing all my gains in one losing trade. So Jason, I addressed this earlier with Alexander, same comments. What I'm confused about is how do I know when the trade is lost and manage my trade so I don't end up giving back all my gains in one trade? I seem to have a very hard time figuring out the exit strategy. I'm going to find you, Jason. The fact that you got in to the trade, the work you're asking about should have been done before. So whether or not your trade is working is something you need to predetermine. You need to predetermine what that looks like before you get in. You need to visualize how this trade is going to work. And once the market breaches it, just cut it. Even if it breaches it by a tick and it ends up going in your direction, cut the trade because your focus should be on the process. You have to be able to trust that you will not blow up your account, that you will follow what you said you will do. It is paramount. It is one of the key differences between a professional in any endeavor and a rookie and a novice or an amateur. Is that you will do what you say you do, even if it bites you, even if short term, that one time, it works against you. You need to be able to trust yourself. And being in a trade, then deciding, is this far enough against me? Is this far enough against me? Understand that your mind, and this is researched, read The Chimp Paradox, a great book. Your mind cannot be objective in a trade or in anything serious. An argument with your significant other, your spouse, or whatever. Understand that in the middle of the argument, at some point, your mind should tell you, I am not rational. This environment will not I'm not in a rational environment right now. Okay. Um, and so understand that once the trade is on, the analytical process is hampered, and you need to make those decisions ahead of time. You need to know that, hey, if once it breaks, if I'm short and it breaks this level above me, then this trade needs to be taken off and I need to reassess. Yes, it's going to cost me money, and yes, that could be the high tick, but that's not the point. The point is to get back to the place where I can look at the chart and I can actually assess objectively what's going on. You are not capable of making any intelligent assessments or research or determination while the trade is on unless you have a lot of experience. It just isn't, it's just, and you're not aware of it. You're like a drunk driver. You're not aware of how impaired you are until after the fact. And the reason I tell you this and the way to test this is I am sure at some point you've looked back at your day or you looked back at what you've done, and you've thought to yourself, what was I thinking? If you have ever said to yourself after the fact, what was I thinking? How could I not have seen that? This is key. This is a key indication to you as a rational, educated, mindful human being that the person holding the trade is not the same as the person criticizing it after the fact. Just like you regret having said something in an argument that maybe you felt, but it didn't serve you to say it. And so so understand that all of your logic and all of your thinking and all of your assessing has to be done before. That's what the trader bite's about. We set things up. You set up your trade management scheme, however you want to trade it. You set all that up beforehand. And so when it's time to go, when it's time to execute, you're not sitting there trying to figure out where to go. Think of yourself as a Navy SEAL or the Green Beret or whatever, and you're about to be parachuting into an enemy location to perform a mission. Do you think that once you parachute, that's when you should pull your map out and figure out what the mission should be and what the exit points are? Or should that have been something that got drilled into you that you're clear about before you even put your gear on, but when it's time to go and jump and kill and do whatever you need to do to complete that mission, you're just doing that. You are executing. And it's the same in trading, believe me. Believe me, it's exactly the same in trading. It's the same when you're a pilot. It's the same when you're a trucker, a driver. You don't sit there and play with your GPS and enter the address as you're barreling down the highway at 160 kilometers an hour. That's not smart. Okay? So just plan it all out. And it doesn't have to be that big a deal. You know, it doesn't have to be that big a deal. You don't have to plan it too much. Just know that, okay, this looks like the market's pulling back. We're near the mid. I am looking for, my bias right now is for a long continuation. Then your plan is, okay, look for an area of confluence, look for something to lean against. I've got yesterday's high at 69.25. I got the IB at 68. I got the point of control at 67. I've got the mid underneath me. This is a very noisy area. I'm going to sit out. But if I had taken a trade, if I took the trade here, I know that I'm probably still okay all the way down into 58. So beyond 58, I'm out. And my target, my initial target is 74.50 right here, right underneath this resistance area, which is represented by a low volume node. That's the beauty of volume profiling. It shows it to you quickly. My first target's ahead of 74.25. My main target is new highs because I'm trading the pullback. Boom. Now you sit here and look for order flow entries, moving average entries, whatever it is you're going to use to enter, and just let it go. Just let it be. Because once you've entered, there's a part of your brain that just shuts down, especially if you're fearful. And then from there on out, just follow your plan. Execute like a Navy SEAL. Don't sit there and argue with your Navy SEAL buddies, whether they should lock and load now or later, whether they should go right or left. It's not time for that. It's time to just follow the plan. Okay? I know that's a lot, but it's just the way it is. Kenji is asking, how do I avoid overtrading? The only reason you overtrade is an emotional need for something, either for it's either an emotional need to be in action, it's an emotional need to fight losses. You're down. Most people overtrade when they're down. It's an emotional need for adrenaline, whatever it is. Know that overtrading is very subjective. You are only overtrading by definition. Just to be clear, you are only overtrading if you're trading more than your plan says you should. So if you're a scalper doing 3,000 round turns a day and taking 800 trades a day, like I grew up doing as a trader, that's not overtrading. That's just how I trade. That's how I've traded. I don't trade like that anymore, but that's how I've traded. That's not overtrading. But if your trading plan says you have 5 opportunities, you've identified these 5 opportunities, and then you look at your journal at the end of the day and you've taken 30 trades, you're overtrading. And you're trading for a different reason. You're trading because there's some emotional thing that is causing you to want to interact with the market. There's some interaction that's going on between you and the market that you're experiencing when you're trading. I've got news for you. We don't make money trading emotions. In fact, we mostly lose money, in my opinion. You're trading the market. You're trading the price action. And that's all there is. Okay? So once you look at this overtrading issue, you'll find that you might be getting a spark out of it. You might be getting some excitement out of it or something. There's something that's causing that. Let me take this mic question real quick to break things up. Jeff, coming to you. Jeff, you're on the air. You need to unmute your mic. Jeff, going once, twice, and sold. Call again if you need it. Let's look at context, big category. Actually, let's knock off some of these trade management questions. Joe, when first starting, is it best to use a couple of contracts with stops at 2 to 3 points and first target 1.5 to 2 points and let second run to some logical target? So I don't know how good a stop is. I'm assuming you're talking about the ES. I don't know how big your stop. I don't know how big a stop you should take because it's a function of your account size. It's a function of your trading periodicity. So someone who's trading off of a 15-minute plan, a 15-minute bar chart is not going to do very well, in my opinion, with 2 to 3 point stops. You need more, things like that. So there's a lot of information that's missing here, but I do what you're saying. I'm looking for about 2 points on my first scale. I'm using the trade analyzer to give me my theoretical average. Once I get a scale out for me to know the true scratch point, that's a very, very important tool for me. And then I take my scale outs at logical points. That is what I do. And trading one contract is always harder, in my opinion, than trading a couple of contracts because you cannot manage your risk by scaling out or by taking in some of the profits and including them into your overall average. So I think that could be fairly sound, assuming your account size is large enough. And the reason I look for 2 points-ish is because that's inside of one harmonic of 3 points. Now it's about 4 points in the ES. I want to take my first scale inside of one harmonic, and we know that there's a very little chance that I catch the bottom of a rotation. A harmonic is basically how it ebbs and flows, how it flows back and forth. chances are I'm not going to catch the top or bottom. I'm going to be in the middle, so I can't go for the full harmonic, so I just go for 2 points. That's just something that I've done for years, and that's what I'm comfortable with when it comes to trade management. Stephen, what are signs you look for to tell you if a trade is going against you, whether it is at your initial entry or waiting for it to achieve its targets? So several things. Hard for me to cover here without taking too much time. I've spent some S5 AMAs on this, but there are several things that I'm looking for, several behaviors. For one, make sure you test out using your sim account first. Here, this broke down through the mid, so now we're looking for shorts. So if I decide to sell in here, do you see I hope you can see my cursor, my pointer. If I sell somewhere in here, and my idea is to sell for the continuation of this rotation. Let me see if I can get the pen here. So this is the rotation I'm trading. Okay, this is the impulsive rotation. And I'm looking for a pullback to continue lower, which it's already done. I'm looking for a low below this. Then when I'm trading this, when I'm selling into this, I'm looking for some size to lean against. These white bars here show size. I'm looking for something that's been there for a while. And once I lean against it, I basically look for what does it have to do to cancel this rotation. So a couple of things. I don't know that sounds very complicated. Hang on. That sounds very complicated, but I am looking for what rotation am I trading? If I'm trading this rotation, then my short, the market should not, or I'm not expecting the market to breach the midpoint of this rotation. So I'm looking for midpoints all the time. Again, when you click on the rotation thing, you see these blue lines, these dark blue lines here, those are midpoints. So this rotation's forming. Pretty soon we're going to get a blue dashed line somewhere in here, and that represents the day's mid as well. So any shorts on this last rotation down here, 12 points, any shorts, I do not want them above the mid. And I don't just get out at the mid. I don't put an order to get out at the mid. I look at how it behaves. So the mid here is 1862. So right in here somewhere, I expect the market to not come up and breach that for this move, for the continuation move lower. Okay, if that doesn't make sense to you, the only thing I can suggest is just be part of the community and ask in the chat room, and I'll be able to get into more detail with it. But I can't cover it here because we're going through so many questions. But if I was looking to get short here, I would probably look for that 62 area as an area to tell me that my trade is not working out. If there's something else that I can lean against, and there is here, if there's something else I can lean against, these areas as it pushes up, this mid from below, the chop, the balance that's happening here, I might add to the trade if that's how it's pre-planned. I might add to the trade, but I still hold my stop so that it risks the same amount of dollars, the same number of ticks once I take out my stop. But overall, that's how I'm assessing if a trade is working or not. I don't assess it by how it behaves immediately on entry. Assessing whether a trade works or not on entry, immediately on entry, it's very deceptive. Things don't look generally don't look as great as they'll come out to be once you enter. So you need to allow your trades enough room. Most people who struggle with trading are just trading too tightly. And they trade tight, and take a lot of little losses. And then one day they say, I'm done with stop losses. I'm just not going to use stop losses. And then that's the day they lose their entire account. Very frustrating. Michael, how do you recommend to enter a trade at pullbacks? So same process, the same process that gets me into any trade So I'm looking for a short here. One of the first things I want to assess is what's around the middle. Again, VPOC, IB high, yesterday's high are all in that area. I'm interested in the short now. This can go neutral. This has a pretty decent probability of going neutral now, meaning 1840.75 being taken. This has a decent probability of that. It has completed its work up top. It has tested the 72 area. Where did that 72 area come from? Again, we have tested the point of control from below, and we have fallen back through the mid. We have fallen back into the initial balance, these yellow lines, and it still has about 2.5 hours to go, 2 hours and 40 minutes to go. Plenty of time for this to pull back, and it's plenty of time for it to go neutral to the downside at 40.75. Okay, just watch it by the end of the day. It has a pretty good chance of doing that. So it's an hour and 40 minutes. So there's plenty of time for it to do that. So if I'm looking to stock short, I'm looking for things to lean against. What do I look to lean against? Either areas of interest that I have here, mids of rotations, zippers. Zippers look a lot like this. These are zippers here where the market bounces back and forth, back and forth. It's forming a zipper right now. Zippers essentially are points in the market where energy is being gathered for the next move. So here's a zipper right here, and it could be it could lead to the next drop, and those are the kinds of things I look to lean against. And once I get in, then I scale out to improve the overall position of the trade through my theoretical average, and then from there on out, I can just relax and manage the trade based on the price action or developing market data. So here it did not fill. Next question. We're getting through these, folks. I know we're over our time. In a market as vicious as this is, how do you decide on entry and exit points and stop? My plan has not changed. My trading method has not changed in about 10 years. Same thing, you just have to widen things out. You have to look at how rotations are increasing or decreasing, and you have to compensate by reducing size or increasing your risk. But with increased risk, you don't keep the same targets because you want the risk-reward ratio to be the same. Same thing, I don't throw away my trading plan just because the market has higher volatility. I just pare down how much I trade, how big I trade. Tony, I'm learning trading through Bookmap. I thought the first stalking trades webinar was excellent. I wonder if you can do another, but this time, rather than focusing on stalking a trade, take us through what you're seeing on the order book as the day progresses. Doing it on a fairly volatile day would be good, as it probably have a larger OTF involvement. I'm trying to learn more about the market movers on Bookmap and what to look out for. Tony, again, all I can recommend is that you just interact with me in the chat room, because I can't turn on a webinar and have it running all day and narrate what's going on. That would be a very difficult thing for me to do, and it wouldn't be very interesting until something happens. But the process is the same. I have my biases. Pre-market, I look for what the market does. Based on what the market does, I'm constantly revising and evaluating for new biases or new hypotheses throughout the day. Rich, I would like more information on validating the entry point of my trades more than just what I see on the charts. Rich, I think I kind of answered that question for someone else a couple of minutes ago. Same process. Let's do study. How often do you update your studies around the percentages of occurrence versus various types of trading days? The latest figures that I saw were from training in 2010. I do these, I update these every few months unless something breaks out. It's a spreadsheet. I don't even know, I don't know if I can display it here, but it's a spreadsheet that I see. Like, I just import data directly out of IRT. I bring the data in and I do my statistics, and here's the latest update, September. So if after a while, I'll bring in more days and copy these formulae down and get more statistics. And I end up with these statistics. How often is neutral occurring? 27.2% of the time. How often is neutral following neutral? 19.2% of the time of the whole data set, but 5.2% of the time after the first neutral, and so on and so forth. How often do we break overnight? High or low? It's 95% now versus 97% 2 years ago. On and on and on and on. I update these as we go all the time. They're just spreadsheets. Also, IRTs become a lot better and easier at doing tests and keeping tests up, keeping these research questions going. It's something that I think Chad created a page for research that gives you like gap statistics and so on. Bill, is there a matrix anywhere on your site stating the main statistics you trade by? How often there's a neutral? That's something that's being created in a new Stage 5 trading website that's going to be released here in the next few weeks. There will be a depository of statistics. And the reason I keep bringing up Stage 5 is because it's just difficult to serve a large group of traders on a blanket basis. But it's easier to focus on the same group, and also within the group there are other people who know the answers and who volunteer their assistance in answering these questions. Do you have similar statistics accrued? I do. Is there a particular webinar that covers the main statistics you trade by? There are many scattered all over the place. I assume a person cannot acquire the data they need to do their own studies on the S5 platform. The S5 platform is for interacting with the market. It's got charts and everything else, but it's not really something I use for that purpose. I just use it for the DOM and for the risk monitor. So it's not something that I have studies for. What should we go to next? Technical. How do you determine a value area? The value area is determined automatically through the software, but the algorithm for doing that, it can be found on the web. Just look up Google market profile, value area computation, or calculating the value area, and there's a lot of stuff out there that tells you how that's done. It's all based around the point of control. Mark, could you briefly go over zippers again as how to best trade them, including execution, especially in this environment? So here's where we talked about earlier about that short trade. See how far it has dropped. Now we're looking for this swing here. So still looking at the short side, nothing's changed. So here it is. It finally dropped. Like we talked about, it's about halfway down to the 40.75 to go neutral. Zippers are these noisy areas right here. So this is a market in trend, so it's imbalance or trending, and then it gets into small balance. And the small balance, these areas of small balance are very important in that they gain energy for the next break. So even though we have dropped, we have an impulsive move down, the market has completed the impulsive move, this is likely to be a corrective move. So short term, over the next few minutes, chances are it's likely to push back up to 58.50. In fact, it looks like it's in the process of doing it now. I'm not going to look short, but if I was looking to get long here, I would look for the market to pull back to a zipper or be at a zipper. So let's say I wanted to get long. Here's your last spot, the last support spot. This is where the last zipper was right here. This is your zipper right here before the break. I would look for that zipper here. So I would look for this area to punch long, to get long, and I would wait for it to pull back, start forming a zipper, and as soon as it starts to break higher, that's when I would lift and go with the market. And basically, I'm trading the pullback in that direction short term. The bigger picture is, of course, short to 40.75. So you have to understand that there are many, many different time frames you can trade in, and I could be talking about different time frames at the same time. So there's the long. See how I said it's likely to go back to 58.50? There it is. This market does not wait very long to execute what its intent is. But here's another zipper that was formed. So let's say the market pushes up, and now we have a reason to get long still, and we're looking for the pullback area. I'm looking for this zipper here to be my support, because it defines to me very clearly that if the market breaks below this 55 quarter, if I get in anywhere around 56.50, 56, 55 quarter becomes a clear area for me to bail out, because if this is to hold, if the long is to hold, it's not likely to get through this small area of balance from which it broke. I hope that makes sense. I know that's a lot to cover there, but that's essentially how it works. Andy, how do you use market profile for longer term trades, not intraday, for swing trading using options or ETFs for 2 to 8 days? So I talked about this a little bit earlier. So for 2 to 8 days, so here, I'll give you one. Let me see, where's the, I'm gonna pull up my options chains. Okay, so ESH6, and I'm gonna go for the near, and let's go on a weekly, 3 weeks out. Let's say 3 weeks out puts me to the mid. So here's the weekly. This is the option chain, and the closest are these prices. If I'm looking for, if I'm looking to trade an option, let's say I'm looking for a call to get long into 1915, then it would make no sense to me to do anything with this until I see how it's reacted at 1872 and that it takes out 1872. Once it takes out 1872 and it starts to barrel through and get back into this next profile, then I would look for the 1915 strike. The 1915 strike, where'd it go? So right there, the 1915 strike, which has nothing on it. It's got no volume, so I need something with volume. Here's 1950, 19. So it looks like the best I can do is 1895 on the weeklies. And you could buy that call for, you know, it's expensive as heck, but 1895. Yeah, these are very expensive because volatility is very high. But essentially what I'm looking for is, once it takes out this, I'm looking for the next key area to test, 1915. I don't hold the options into expiration, and it sets out my expectation, and it gives me an idea of, you know, how far the market has to breach. It doesn't have to go. I don't let the option become worthless even if it's not working for me. If I'm long an option, I know that if it breaches a certain key area, that it's time for me to look for an exit. And certain key areas are based on low volume nodes, high volume nodes, the point of control, and so on and so forth. And that's basically what I look at when I look for the longer term perspective. For 2 to 8 days, all you're doing is stringing days together to see what's in the way, what the market needs to do from an auction perspective to fulfill its mission. Michael, what are the system requirements to use your platforms? Do I have to use Microsoft? Oh, I didn't know this was more of an S5. You need Windows. You need a fairly decent machine, and you can trade on your iPhone, iPad, Android device using the S5 mobile trading app. Otherwise, you're just using a Windows or a Windows emulator on the Mac. That's basically it. Greg, big question here. Let me move down to something quicker. Sorry. Simon, I looked at your question. It's huge. I do need to address it. I apologize. I haven't answered it since December 22nd, but it's really, really big. I don't know. It sounds like we need to set up a time to talk, really. I know you're a stage 5 member, so I can do that with you. I can't answer that here. It's too big. Larry, I'd like to know a little bit more on how you would potentially choose options. Okay, Larry, I just covered that. Grace, I've seen your use of Bookmap. I've also seen peeps use both. I don't know what both is. I don't know what the other side is. By style of trading or preference, how would you choose between the two? I'm not sure what the comparison is. I'm guessing Jigsaw or some other thing. It's really a personal preference. They both do similar but different things. My preference is for the S5 Bookmap. Richard, can you explain how Market Delta works in IRT, how to use it? Okay, so it's not Market Delta, it's Delta. Market Delta is a company. The delta that I use, which is the bottom here, which is at the bottom here, this is essentially measuring how many people hit the bid versus lifting the offer. And what it does is it tells me the force behind the move. So if we see a huge move down and delta is sideways, it tells me that either somebody was hitting the bid on the way down, but somebody else was lifting the offer. In other words, somebody was confronting it and buying and lifting the offer, which means that as the prices went down, somebody's accumulating, right? That's what it's likely to indicate. Or as the prices dropped, the bids were dropping, and so there was no volume hitting the bid. So price prints, if the bid's canceled and the next print is a one lot, 10 points down, you're going to see one big candle, 10 points, and it traded a one lot. The candle itself does not tell you what really happened. But with the delta, with this volume breakdown indicator, as it's technically called, with the delta, we can see how vigorous that trading was. So we could see that the selling down here, the selling from 1867.50 down to 55.25 was pretty vigorous here. It went from about 18,000 down to about 9,000. We sold 9,000 contracts in this rotation of 12 points. That's pretty comparable. It's most interesting when price has moved and delta has not. And it's not consistent because the delta at the open, when the bigger participants are in, when most of the volume's in, is not the same as delta later. This is why I don't use delta divergences. Delta divergences are when the market makes a high and the delta is at 27,000 plus, and then it pulls back and it makes a higher high, but then the delta is lower by 22, like it goes to 22,000 instead of 27,000. People call that a delta divergence. But if it made the first high within the first half hour or hour when the market has the most active traders in it, and it made that second high over lunch, that doesn't tell me much. It's deceptive because it looks like they tried to make the second high on a weaker delta, but actually it made the weaker delta because there were no real participants in the market. It has nothing to do with anything else. And so I don't use it for delta divergences. I just use it to look for how aggressive a move was. Okay? So here's the pop-up from 52 to 64, pullback, and then now pushing 65.50. The delta is on course with that. You could see that it is lifting with price. This is legitimate. This is legitimate versus a market that's running up, but delta is just sitting sideways or falling. You'll see that a lot in the NASDAQ where price is going up and delta is going down. That gets my attention. Okay. I'm worrying out, and this is very long, and I know there are many, many questions. There are about 600 of you in here who also ask questions in chat itself in the question area, and I cannot get to all of this. So I'm going to have to cut it off here. I did my best to get through as much as I could. Try to address the general questions first, because they affect more people. I address the psychology questions, which address the most people, affect the most people, and the technical questions, which again address the most people, as well as trade management. But I could not get through context and these S5 questions. If you asked one of these S5 questions, please just go to the website, go to the support area on the menu, and shoot click on contact and shoot the brokers a message. They'll be able to answer these. It's not necessary to answer these in an AMA. They'll be able to handle your need at that point. Thanks for coming in. I apologize I didn't get through everybody, but we did the best we can. We don't want this to run over too long. Again, there are more questions than I can handle. I think there were close to 80 questions, but I appreciate you coming in, and hopefully you learned something today. Good luck. Take care.